many of you may not know this. I did work in the securities business for 15 years. I'm in a recovery program now. I take it one day at a time. But this would have been back in the 70s and 80s. And it was right when we had that really big bout of inflation that some of you remember, when you could get a CD paying 18%, you know, a 3-month CD for 18%. Wasn't that great? No, it really wasn't great at all. Because after taxes and inflation, you were still losing money on your CDs. But anyway, most of the work I did were clients who were buying municipal bonds and putting together tax-free investment portfolios. And so the interest rate spike up happened really fast. And so I'd get a call, or somebody would come into the office and say, George, I just got my statement and my bonds all dropped about 10%. And I would say to him, yeah, well, we've had this spike up in interest rates. I don't know how it's going to go, but realize you bought individual bonds here, and if you hold on to maturity, you're going to get your money back. There's no ifs, ands, or buts about that. And I say, okay, all right, well, I'm glad you told me. Next month, another 10% shaved off because interest rates kept going up and the bond price kept going down. And it was after they dropped about 40% that they would come in and say, Uncle, I give up. I can't hold. My wife's killing me every time she looks at that statement. She says, what did you buy for us? What did you put our money into? This has lost 40%. I got to get out. So what are you going to do? If that's what the client tells you to do. You sell the bonds. And they took enormous losses on those. If they'd have held on to the bonds, because as fast as interest rates went up, they came down just as fast. And if they'd held on to the bonds, they would have recovered all of the market loss that they'd seen, the paper loss. And actually, interest rates fell so far that the bonds would have actually been worth more than what they paid for them. But what did they let get involved in their investment decision? Emotions, exactly. And that's what's going to get you every time, okay? So, that's why you have to be very careful in here. Now, I don't own a bond, as this is not breaking news. I don't own a bond. I never will own a bond. I have no interest in bonds at all. But with that said, that doesn't mean that you shouldn't own bonds. And I think that if you were looking for income on your investments right now, I was speaking with a company the other day to their employees about the investment choices that they had in their 401k program. And they had a long-term bond fund and a intermediate-term bond fund. And obviously, the long-term bond fund, the longer you lend somebody your money, the more interest you're going to get paid, had a much higher rate of interest. Probably around, it was a taxable bond fund, a government bond fund, and maybe around 5%, something like that. The short-term bond fund was yielding about 2.5%. And if you just look at that as a source of income, the long-term bond looks great, okay? But when rates start going up, that's where the price plunge is going to take place. In the other portfolio they had, the short to intermediate term bond fund, the average maturity in there was about 3 years. Well, that does two things. Number one, it protects you from market volatility. Sure, there'll be a little bit. But what that means is also that those bonds are going to be maturing in 2 or 3 years. And if rates go up, they'll be able to replace them with bonds that pay a higher rate of interest. So if I had to buy, if somebody came and took my arm and twisted it behind my back and said, Chamberlin, you got to buy a bond fund, which would be such a strange scenario if that happened. I don't understand why anybody would do that to me. But I would say buy a short to intermediate term bond or bond funds, and that will help you write it out. The other problem with bonds is, and this goes back to the reason you invest in the very first place. What's the most important reason for investing and exposing your money to risk? No. One reason and one reason only. You've got to have your money grow at a rate faster than the rate of inflation. Inflation is what is putting people in the poorhouse when they retire, because they're living, darn it, they're living too long, okay? That's what's happening. It used to be, I remember with my grandfather, my dad, once they retired, that was about it. There wasn't much after that. Now people are living so much longer, and they're living very active and productive lives. Okay, so what happened is that if they put all their money into bonds, they have no inflation protection at all. And what was the other thing I looked at when I did that? I did a report on the Triple Crown thing, and I looked at a couple of, the average price of a home 37 years ago was $17,000. Okay. My brother bought his first house in Pasadena for $16,000. This was darn close to 50 years ago, but today it's worth about $3.5 million. You bought it in a bad neighborhood, which is now a great neighborhood. It's been gentrified, as they say, okay? And so that's what has happened. But inflation's there. I mean, I believe inflation for the most part is very low right now. I know that's hard to say here in San Diego, but trust me, if you lived in Ames, Iowa, okay, you wanted to rent, you'd buy a house, you'd rent a nice, really, really nice place for $600 or $700 a month. You wanted to buy a house, you could buy the best house in Ames, Iowa for $250,000, okay? And the cost of gas is about 2/3 of what it is here, less than that probably, and everything's cheaper there. There's only one problem. It's in Ames, Iowa, What are you going to do, okay? That's the rub, okay? We all realize that we live in a very expensive place here, and that's just the way it is. So, but you've got to protect your money against inflation. Let's say you buy a bond, a bond with a 30-year maturity, which is kind of normal if you're buying a long-term bond. And that bond is paying you this year $30,000 in interest, okay? It's got a rate that is a fixed rate. It's going to pay you $30,000 in interest. Next year, it's going to pay you $30,000. Next year, it's going to pay you 30 years. And on the 30th year that you have it, it will pay you $30,000. What do you think will be the buying power of that $30,000 in 30 years from now compared to what the buying power is today? Half at least. It would be half the buying power, probably even less than that. So you've got to protect yourself from inflation. And historically, there's two ways to do it. Stocks and real estate. Stocks and real estate are the two.